Welcome everyone to our webinar on habitational insurance. I will be your host for the next 45 minutes for this informative session. My name is Barry Whitten, Managing Director of Burns & Wilcox Brokerage in Atlanta. I've specialized in large commercial property for over 37 years, with experience both in the retail and the wholesale side. I'm happy to introduce our panel of experts on this subject matter. First off is Nick Freeman, Associate Managing Director, Casualty Broker for Burns & Wilcox Brokerage in Dallas. Next is Kevin Kyler, Manager Commercial Insurance, Burns & Wilcox in New Orleans, Louisiana. And lastly, Jake Miller, Property Broker for my team here in Atlanta, Burns & Wilcox Brokerage. A few housekeeping items to start with. Our seminar will be about 45 minutes, and our panel will go through several issues related to the habitational insurance, the state of the market, market challenges, opportunities, and a forward outlook at what the market looks like. And then hopefully at the very end, we'll have some time for questions and answers. Also, you'll notice that if you want to ask questions, there is a question box up in your right-hand corner, and all you have to do is type your question in and send it, and then we'll be able to answer those questions. So let's jump into the seminar. First off is the state of the market as respects the habitational. National Multifamily Housing Council and the National Apartment Association combined to do research, and they said that U.S. needs more than 4.3 million new apartments between now and 2035 to mitigate all issues related to the apartment demand and the shrinking supply of affordable housing. This study attributes the increased demand to the following. You got a rise of young adults between the ages of 18 and 34 who are delaying the home ownership. We have an aging baby boomer population who are choosing the convenience of apartment living over owning a home in the later years of their life. Also immigration, which will account for about half of all the new U.S. population through 2030. So when you look at it, the demand for apartments is an all-time high, as renters has reached an unprecedented level. About 39 million people, meaning almost 1 in 8 of us live in an apartment. With that being said, I'd like to get to our panel and have a discussion on the state of the market. So Nick, I'll start with you. Can you give us an update on the state of the marketplace as relates to casualty?
Yeah, thanks, Barry. Good morning to some of you. Good afternoon to others. I'm Nick Freeman. I'm Associate Managing Director in the Dallas office of Burns & Wilcox Brokerage. The state of the casualty marketplace, for those who kind of dabble in this space, for the past few years, starting around COVID or a little bit afterwards, I started seeing pretty substantial rate hikes kind of across the board, all parts of the country. The past year and a half, 2 years, that's kind of stabilized to a certain degree to where those double-digit and large double-digit increases have kind of moderated to where a lot of times, everything being equal year over year, that's kind of low single digits now, maybe upwards of 10%, 10, 15%. So the good news is, for the insureds who were taking those substantial rate increases several years ago from what they were used to, that's kind of flattened out to a large degree. However, what we have seen is a deterioration of terms, conditions from assault and battery, sexual abuse, firearms, weapons, habitability, and it kind of goes on down the list depending on part of the country and the carrier. So while there is some good news for the rate stabilization, the terms, conditions are still kind of getting squeezed, particularly for those insureds in states like New York, Texas, Florida, Georgia, even California. They're kind of taking some of these increases a little bit higher than some of their peers, and also some of the rate restrictions, or excuse me, the terms and conditions restrictions as well. From the excess standpoint, there's not been a tremendous amount of change as far as positive news for a lot of the insureds. Some of these programs have gone away. Online facilities, risk purchasing groups that used to offer pretty high capacity at pennies on the dollar. A lot of those took losses, kind of went away. So a lot of these insureds are finding themselves in the E&S marketplace and able to buy much less limit at a much higher price. So, unfortunately, whether it's the property or the casualty side, it's kind of a tough time for a lot of these insureds. There's some glimpses of positive news in some spots, but overall, it's still a pretty tight marketplace from a rate and a term standpoint.
Thanks, Nick. So, Jake, I'm going to go to you. The same kind of question, but as specific to brokerage property.
Thanks, Barry. As you mentioned earlier, my name is Jake Miller. I'm a property broker in our Atlanta office on Barry Whitten's team. I think to start to look at the state of the marketplace from a property standpoint, it requires us to review the last couple of years in this marketplace. Throughout 2019 and 2020, majority of this London marketplace in particular pulled out of the primary HAB space. This contributed to, one, a hard marketplace for HAB-specific occupancies the past 3 to 4 years, resulted in a handful of our domestic E&S carriers offering competitive terms for HAB occupancies. So really, we lacked competitive players throughout the board. And then after London pulled out, they were really only competitive placing capacity in the high access layers for large layered type accounts. If they were to offer on a primary basis, it would be opportunistic rate online plays only. And historically speaking, for not only HAB occupancies, but really the E&S property marketplace as a whole, rates have increased steadily each of the last 5 years. Along with rates, deductibles have increased over the years for both AOP, as well as wind, hail, and named storm. In addition, there's been a reduction in capacity and limits from both our domestic marketplace and our London marketplace, as I previously touched on. And there's been a heavier focus on property valuations, which we can get into a little bit later. For today specifically, in the state of the marketplace presently, London is now re-entering the primary HAB space with some more competitive rates, but they have caveats to go with that. Additionally, there's more domestic markets that are now re-entering the marketplace and or increasing capacity if they've already been playing in this space. Rates are beginning to level out. Currently, we're seeing small increases, rarely getting flat renewals for our clean accounts. And for those with losses, it's a case-by-case basis. And lastly, the deductibles are still staying around the same increased rates that they've come in at. Lowest we're seeing our AOPs is around 10K, some higher depending on the occupancy. And our convective wind hail is at 3% with our named storm starting at 5%.
Thanks, Jake. Kevin, I'm going to come to you with 2 questions. One is the same kind of a question that Nick and Jake answered, but kind of outlining what the differences in your marketplace is for binding and contract markets versus the brokerage markets. And then another follow-up to that is, since you're based in Louisiana, maybe you can give us and expound on what's happening in the coastal wind issues facing the current marketplace as well.
Sure. Thank you, Barry. Appreciate it for Barry's introduction. I'm Kevin Kyler. I'm the commercial lines manager in our New Orleans, Louisiana office here for Burns & Wilcox. So yeah, just kind of opening up, what the last few years have been like, obviously, and not just the last few years, really gone back to about 7 years ago. It's just been unprecedented hurricane activity, named storm activity on the Gulf Coast, from Key West all the way to Houston, and varying events really. Probably the most notable wind event was one of the most notable was Hurricane Ida here in Louisiana, which, it's been almost 20 years since Hurricane Katrina was a terrible event locally here in New Orleans, but that was primarily a flood event. Hurricane Ida was a wind event that caused the majority of the losses. Pivoting over to Hurricane Harvey in 2017 in Houston, that was primarily a flood event. So, all this has added up to, unfortunately, what many people who have been in this industry for a long time have deemed this to be a generational hard market. So, last year in 2023, the Gulf Coast as a whole, as far as named storm activity, Florida did get hit by Idalia, but if there was a place to hit in Florida, it hit in the Bend of Florida, which is a lesser population and lesser property values. So the impacts of that, fortunately, were not felt as much as some of the prior storms that we've been hit by. So, like Barry said, I wanted to kind of just give a brief idea of, how my side differs from Jake. So I'm on the binding property side. So we're usually looking at smaller property values. When it comes to habitational risk, we're looking at smaller amount of units, generally under that $5 million total insured value mark on condo associations, apartment buildings, short-term rentals, things of that nature. So really what this has done in the binding space, it's caused some long-term players to pull out. Scottsdale, Colony have pulled out, as well as many others. So the main players in our area have still been our London syndicates. With that being said, like Jake said on his side, it's caused reduced capacity from those London markets and kind of consolidated to fewer brokers that they work with. So it's been very tough, but like Jake said, unfortunately on the binding side, we are seeing similar, finally a trickle of good news and optimism with rates. So renewal rates are trending towards flattening out or much smaller increases than we've seen in the last 3 years. So it does feel good to have some optimism finally. Further on in the presentation, I'll kind of go into how these last 7 years have kind of given a game plan to our carriers of how they want to deploy their aggregate going forward. And in this age with data and analytics, it's provided so much information and analytics to our London markets. They're able to utilize that to game plan and how they want to work going forward. So I look forward to discussing that a little more further on in the presentation.
Thanks, Kevin. And I think I want to stay with you for a minute if I can, because obviously we want to talk about habitational. We've talked about the marketplace, and we all know the marketplace has been difficult the past few years, and hopefully we're beginning better with some positive signs that you said. How specifically has this affected the habitational occupancy itself?
Yeah, so, kind of going back to my last comment of the data and how, properties have performed in the Gulf Coast. Unfortunately, a lot of these habitational properties have performed quite poorly. So, when we were looking at occupancies going forward and these habitational occupancies, unfortunately, they're bearing the brunt of these rate increases. And unfortunately, the end product of that is increased rents for renters and tenants that are being passed down by property owners. Condo association, those association fees have been greatly inflated. So, like I said, unfortunately, this habitational class has bared the brunt of this activity. But like I said, hopefully with more of these, with more competition entering the market here, and hopefully a quiet storm season 2024, we're going to see improvement on especially the habitational side, because it's needed. So,
thanks, Kevin. So, Jake, I'm going to go to you. So, outside of coastal areas, habitational has its own unique challenges that you face as a broker. Can you share what some of those are and some of the issues the marketplace has with habitational accounts?
Sure thing, Barry. So some challenges within property habitational, I'd like to group these into about 5 different categories or contributions. First being the occupancies within this habitational space. Second being construction types. Third is the age of the properties or the year built for the properties. Fourth is the updates or lack of updates, as well as protective safeguards. And lastly is challenging locations outside of the cat space that Kevin mainly touched on. So let's start with the occupancies within the habitational world. There's a couple that outside of the normal apartments and condos we see that generate some additional conflicts or need a greater attention to. That's student housing, that's Section 8, as well as our senior living and assisted living. As for construction types, I think we're all aware that the 3 main challenges are the frame, JM, and NC, or the inferior constructions that some of our underwriters like to put them as. And we generally don't see NC construction within the habitational space, but majority is frame, and frame capacity is always the most limited with our underwriters and our London markets. Being non-cat, it's generally okay having AOP coverage for it, but we won't get as much capacity for these compared to an MNC condo or a superior fire resistive. Third category being the year built of the properties. There's challenges from a number of different angles with this. The pre-1995 challenges for the cat properties that Kevin and I both see, but outside of the cat areas, if we have buildings on historical registries, that's sometimes an automatic declination for some of our partners. But to go hand in hand with the age of the building is the updates. Really, our markets need to see updates for a lot of these older buildings in order to give a replacement cost valuation or to even consider them from a property standpoint. That updates for not only the roof, but plumbing, wiring, and HVAC. Within wiring, you can have challenges with aluminum wiring, which we still see from time to time from the 40s to 60s year built properties. If there's aluminum wiring, we're really narrowed down to just 2 or 3 markets that can truly compete on that. And that requires us to get additional information from your clients regarding, has this been remediated? Is it completely unprotected? Is there plans to gut out the aluminum wiring and replace it altogether? And then lastly, going into the safeguards of the building is, are these sprinklered? Are they non-sprinklered? Are they alarmed? If there are no protective safeguards in place, do they have fire patrols that go in and do a walkthrough with the building owners? There's a lot of different items, and if we can generate some sort of story behind that, it gives us a better opportunity to bring more players to the market. And then lastly of these categories is the challenging locations outside of, the Gulf Coast, the East Coast. And that starts with the convective wind pool that has really expanded since 1995. It was really just over that Texas, Oklahoma area, and it's expanded very far east into the state of Georgia and far north as high as Ohio. And that's generated the separation of our AOP deductibles and our wind hail deductibles. Now we're seeing wind hail deductibles really starting at 3% for those convective areas. And some of our players automatically decline coverage for wind if it is in that heavy area for wind hail exposure. Outside of wind hail, we also have our wildfire and high PC areas. Those can create some conflicts with either sublimits on our wildfire coverages or automatically bumping up the AOP from what we would expect to come in at 10,000 to as high as 100,000 or 250,000. It really is very account dependent. And then lastly is the high crime areas. This can create some exclusions within coverages, certainly sublimit with our theft and other areas within our policy forms.
Thanks, Jake. So Nick, I want to come back to you because I know we've been talking property for a long time, so I wanted to wake you back up. I know that's not your favorite subject matter, but you've mentioned specifically certain areas that are more problematic for liability, especially as it has to do with the marketplace. Interestingly enough, I think 3 of those states you mentioned are also some of the highest growth states for apartments: California, Texas, and Florida. So can you kind of give me some of the challenges that you face as a casualty broker placing a habitational account?
Well, Barry, in the southeast, close to you, down in Georgia, Florida as well, and you can throw Mississippi and Alabama into this category as well. It's all kind of about assault and battery coverage. I think we all kind of understand from a casualty standpoint. It starts with slip and fall, premises coverage. So you start with a pretty big world, and then some carriers, particularly over the last few years, have kind of narrowed their coverage down. Not excluding slip and fall, but gone on to assault and battery, sexual abuse, which kind of tie into the higher crime score area. So in New York, Georgia, Florida, even Texas now, almost any metropolitan area, carriers are running crime scores, which more than loss runs oftentimes dictate the amount of assault and battery coverage or lack thereof they're going to get. So it can start anywhere from being silent, which is what you want, all the way down to excluded and everywhere in between. And even if a carrier provides assault and battery coverage, they'll sometimes then exclude weapons or firearms. And, and a lot of these forms aren't ISO, there's not a standard of basis for them. Every carrier reads a little bit differently. So, in those areas, a lot of times, like 5 years ago, 6 years ago, you'd get a quote and it'd have an assault and battery exclusion, sublimit, anything other than silent. And you just put that quote to the side. It was garbage. You couldn't use it. There'd be 10 others behind it that were perfectly fine. And now that's more the rule than the exception. And you're kind of looking for that diamond in the rough that actually, can either provide silent A and B coverage. That way you can continue that coverage through the excess, or $1 million. Well, if $1 million is not possible, can we get 500? And then going on down the line. And so you're circling through a lot of these carriers who have had, poor loss experience, that look at the crime scores, that look at news clippings, articles on the internet. And even if nothing's showing up in the loss runs, as far as a loss of that nature, they may find, something they don't like elsewhere. So that's proven to be one of the challenges that's popped up more and more, over the past 5 years, that, really, it's more problematic in some states, Barry, but even in, Missouri and Indiana, Illinois, you get close to really any large city, and there's going to be pockets where the crime is more poor than others. Carriers are going to see that, and unfortunately, it's one of those things that's pretty difficult to outrun. You can't really fight a crime score or paint a picture or make it seem a little bit nicer than what it is. A lot of these crime score companies, it's narrowed down to the exact location and doesn't necessarily pull from a larger zip code. So it's again more problematic in some areas than others, but it's creeping up more and more. And finding those carriers who are willing to offer silent on A and B is now one of the more problematic things we face every time we get a habitational submission.
So you mentioned a couple of things, Nick, about some tips and advice. So let's stay on that topic. Can you give our clients any kinds of advice as to if they have those problems, they know they're going to have those problems, how they to address it, how to contact you or a casualty broker in advance to address those issues, to present themselves in the marketplace in the right light?
Yeah, as much as they can. This is a high frequency, high transaction business, so it's hard to spend a tremendous amount of time on every single apartment complex if you're dealing with one-off schedules versus some of the larger ones. But as much as you can, and we try this as well when we send submissions to the underwriters, is paint as nice of a picture as you can. The crime score is a crime score, the losses are the losses, but try to include a story about the losses. Is this just an investor who's going to hang on to an apartment complex for a few years and then flip it? Or is it somebody who's a little more invested that takes care of these properties, that tries to prevent things before they happen rather than reacts afterwards? So, 5 years loss runs, life safety data, SOV, supplement, accords, you try to start with as much information as you can. You don't want to overload anybody, but as pretty as you can make a submission up front, try to anticipate their questions. Don't let them underwrite, so you don't have to do that for them. But if you deal in this space often enough, what they're going to look for. And you try to get out ahead of it. I spoke to a friend earlier who said that he gets upwards of 4,000, 4,500 HAB submissions a year. Half of his desk is full of HAB submissions. And this isn't even a carrier who specializes in the class. It's a little more opportunistic. So if he's getting that many submissions, one underwriter at one company in one office, imagine the carriers who do nothing but HAB. And their stacks get pretty deep. Everything kind of looks the same. So whatever you can do to separate yours, even if it's not a well-performing risk, if there's a story that goes along with it, or you can provide me information so I can paint that story, it may move up that list to otherwise, somebody who wouldn't look at it or would just set it to the side because all they see is 4 pages of an accord, some losses, no story, no SOV. They just move on.
Got it. Thanks, Nick. So Kevin, I'm going to come to you next. And just for everyone out there, we're getting some questions in. We'll try to build those into the presentation. And at the very end, we'll get through as many of those questions as we can. So Kevin, coming to you. So tips and advices you may have in the binding market area. And also a question did arise asking about short-term rentals, Airbnbs and things like that, VRBOs. I think that may fit your world a little bit better, if you don't mind addressing that.
Sure, absolutely. Yeah, I like what Nick, just mentioned, just painting that picture and narrative. It really is just an inundation across the board, not only with casualty and brokerage property, but myself as well with binding property. Just the amount of submissions, the amount of business that needs a home for. And going back to some of Nick's earlier comments, it's because of these carriers pulling out these programs that have been around for 15, 20 years are just no longer around. So everything's getting shifted to our E&S space. So, it really is just so important to get ahead of the renewal progress, whether that's, of course, getting all the appropriate documentation, accords, SOV, supplementals, but also providing some additional information as far as pictures of the interior units and improvements that have been done. If there's a property manager that manages the property that is nearby and is checking on that frequently, that makes a big difference for our carriers as opposed to an individual or a property owner that may own, triple-digit duplexes and smaller habitational properties across a couple different cities. That attention to detail that a property manager is able to give to these individual properties can make a big difference. One other thing I wanted to mention in the renewal process and the tips for creating a quality submission and producing a quality quote is valuations. It's been a big hot button topic on the property side really in the last 4 years or so. Going back to my earlier comment about data that carriers have to review, a lot of the most poorly performing properties in these cat events, these hurricanes, named storms, have been properties that were underinsured. And throughout the years that we may have not have given that a closer look as we should have as agents and wholesalers. But that has changed in the last 3 or 4 years, and a lot of attention has been paid to making sure these properties are properly insured. Co-insurance, a lot of properties have an 80% or 90% co-insurance. While that is something that's read in the policy, it's meant to be a buffer, and we really want to make sure we're insuring properties to their proper value. So, with that being said, that process has been playing out for a few years now. So a lot of these valuations have been brought up to this point. So fortunately, we are where we need to be on values for the majority of our policies that we have in place that are renewing. So it's good that we've gone through that process, and we are at the point we're at now. For short-term rentals, obviously, Airbnb, VRBOs have become a thing, especially in the last decade. We all stay in them on traveling and things of that nature. And it's different risks than a long-term tenant or a condo association, but some of our carriers don't like them. Off the back, it's an automatic declination. Some of our carriers do like them. One aspect you have to think about, some of these property owners that have Airbnbs that they market in high tourist destinations, things like that, they've put some work into their properties to improve those properties and make them more attractive than the other rentals nearby. So, that's one aspect that is a major positive that some of our carriers have found. Another aspect is a owner that lives on site, maybe that they're renting out a separate portion of their home. That makes a big difference. A minimum renter age, a lot of our carriers like a minimum age of 25, 27. So it's a new type of risk that is interesting, and we do have carriers that like writing them, and yes, it's obviously become a lot more prevalent. So
Great, thank you, Kevin. So Jake, I'm going to come to you and to talk about maybe some tips and advice for dealing with these challenges. And we had a question that came up about knob and tube wiring, aluminum wiring, all those things that we know are challenges for some of the older properties. How do you suggest you address that up front, knowing that the marketplace is very limited for those types of things?
Gotcha. So I'll start by addressing some of the tips, and then we'll go into that aluminum wiring question. I think both Nick and Kevin had addressed some very important items that hold the same value with the property brokerage marketplace. Having full context and full high quality submissions is going to put your submission at the top of the stack with underwriters. We're seeing high volume just as every other type of insurance is seeing. And, they don't want one document that has 100 pages in it and asking, please quote. We're not going to get anywhere with that. And we know that, and you guys know that. So, some things outside of what has already been mentioned, I would say for the agents to start reviewing their book of business the next 6 months, next 8 months of this year, and try to identify some of the accounts they think are going to be challenges, whether that being this account had some significant loss history within the past year. And we know that, if it's in the standard marketplace, it is going to be kicked out and they're going to need a home, whether that's for the next year, next couple of years. We can't predict what the standards are going to do a year from now, but in the meantime, they're going to need coverage. So getting kind of an idea so that we're not scrambling with 30 days left, going out to market saying, hey, we're expiring with 13 cents, and then sticker shocking your client, and then you get fired because they weren't prepared properly for the significant increase in terms of pricing from the E&S marketplace. Outside of that, just preparing proper submissions, getting the full court applications. We need an SOV and a court just to get clearance in any of our markets now. It's not something we're trying to be picky on, just something that we're now being enforced to follow suit with our underwriters. For those of you that need an SOV template, we've created one from the brokerage side for property that highlights a lot of the key areas that our underwriters need to look at, starting with general information on the property, COPE information, highlighting some of that aluminum wiring, some of the alarms, protective safeguards. We don't need to fill out every single box, but the prevalent things and account-specific items that we want coverage on, we're going to need to answer. And then over time, if there is that large loss or an open loss, that's E&S marketplace is for those hard-to-place risks. If there's an open loss of multi-million dollars, let's get the story behind that. Let's talk through, what process are they in from a timeline standpoint? Is this almost finished with repairs? Is it something that hasn't even started yet and there's a tarp over the roof? Let's get an idea so that we can cookie cut this type of policy that suits your client properly. And then let me go touch back on that aluminum wiring question. So kind of falls hand in hand with what I was just saying. If your property has aluminum wiring, let's not leave that box empty or put copper and then tell us 2 weeks before that it's actually aluminum, because that's just going to wipe out every piece of quote that we have on the table. Let's get ahead of any problem. Aluminum wiring yet is a problem, but there's solutions to it. There may be, we need to bump the AOP deductible up a little bit, or there may be certain recommendations and timeframes that our carriers are willing to work with, say within 180 days if you remediate XYZ portion of your aluminum wiring. If it's fully not repaired, there's going to be limitations, and we need to know what those limitations are and talk that through with the clients and give them enough time to decide how they want to go about it. But there's no easy fix with property. There's no, rabbit in the hat for property these days, but it is getting better and it's getting more promising. So just giving us adequate time to talk through these accounts is the best way to handle it.
Thanks, Jake. So whether it's property or casualty, if you have issues with an account and you're going to have issues with the account, the best is to talk early about those, talk often about those, communicate, and that gives us more time to actually have good communication with the underwriters to hopefully bring an option to the table. Jake, I'm going to stay with you because I'd like to have just a quick snippet of what you think the marketplace may do for the rest of this year, habitational related or just as a whole. What do you think the property brokerage marketplace is going to look like?
So I think the property marketplace is going to go hand in hand with the habitation marketplace. I think that there is some positive trajectory with this being, like Kevin touched on earlier, valuations have, for the most part, been addressed. That was such a major player in seeing all these 25%, 50%, 100% increases across the board from previous years, because a lot of these properties are written for a fraction of what they're supposed to be valued at from a replacement cost standpoint. So now that that's been addressed, and we've had, knock on wood, a couple of years of positive growth from a loss standpoint, I think that we'll see anywhere between, on average, 5 to 15% on our renewals for increases. Some accounts may be flat. Maybe we'll not see an increase at all. It's really account specific. But these are for the accounts that are clean and not dealing with $3 million open losses. I think we should be understanding that those are the trickier ones that need to be talked through. As for the deductibles, I think they will probably stay the same from a 2024 standpoint. I haven't seen anything since the start of this year of deductibles lowering. Still at that 10K AOP starting, sometimes higher depending on the risk, and really starting around the 3% wind hail for our non-cat areas and 5% named storm for our coastal areas.
Got it. Kevin, talk coastal specific, but in the binding operation, what do you see for the rest of 2024?
Sure, yeah, but somewhat similar to Jake's outlook, and as I mentioned earlier, it does feel good to have some optimism finally. As far as the deductibles on the binding side, coastal areas, especially the frame, non-combustible, which there's not a ton of on the habitational side, but that's going to be staying at 5%. The AOP deductibles on the binding smaller property side will get down to the 5,000 AOP or maybe even a 2,500 in some cases. Prefer construction if we have a MNC or maybe an old historic joisted masonry property that's performed well throughout the years, we can get down to a 3%. As far as rates goes, finally, and if it was 2 years ago and we only had a 15% rate increase, then that was a positive news, unfortunately. But at this point, we are able to internally manage our book to where we are looking for, hopefully in most cases, a 5% increase. And maybe, like Jake said, in some cases for preferred accounts that have performed very well, we may be even able to come in flat, which is great and much needed on the habitational side. Like I said earlier, with that end cost being transferred to the tenants and associations. So again, great to have some optimism finally.
Yeah, absolutely. I agree. Nick, give us your perspective on the GL world for the rest of the year.
Yeah, I think for the most part, Barry, like I said earlier, single-digit rate increases for the most part, unless there's been some loss deterioration. The terms are going to be the terms. There's nobody seemingly rushing in all of a sudden and offering silent A and B or habitability, eviction, weapons. So, a lot of that's going to persist. And what I would recommend for that is, when you see those quotes, pay attention to the forms, read the forms, since they're not all created equal. When you have that renewal coming up and you know what carrier it's with, what is that carrier doing? Are they taking a kind of a broad reach and applying, certain restrictions or exclusions to everything? Are they looking on an account by account basis? So as much as you can, try to anticipate what they're going to do, have those conversations with them. It's kind of a difficult balance between scaring a client away or, kind of trying to warn them or kind of give them a heads up. But at the same time, you don't want to come in at the last minute with something that looked entirely different from last year, especially if you're expecting the insured to pay more for it. So, the terms are going to continue to contract a little bit. It's been the case for the past few years, so it's nothing really new there. But try to get out ahead of it, warn everybody, read the forms. Try to get a market list from your broker that you're working with. Make sure that they understand the marketplace. They're going to the proper markets, because if they don't, somebody else may come behind you and get to those markets, and then all of a sudden, they're approaching your insured, pointing out all these flaws in your policy that you may not have known about, you may not have discussed with them. So, like anything else, just try to get ahead of it. I don't think it's going to substantially improve over the next year or so, but a lot of the pain, has already been felt for the past 4 or 5 years. So it's, just trying to manage expectations as much as possible.
Got it. Thank you. So I think we have time for a few questions. And just for everybody's point, we'll be sending out this information. You'll get a copy of this recording with some other details. I know people are asking for contact details and things like that. So some of that information will be forthcoming after this is over with. And Nick, I got a question for you. Do higher deductibles help with pricing or coverage in the GL space?
Sometimes yes, sometimes no. It depends on the amount of the deductible. If you're starting at $1,000 and maybe looking at 5 or 10, a 5,000 deductible, 10,000 deductible nowadays doesn't really take a carrier out of harm's way, so to speak. Slip and falls, very minor claims that used to go for a couple $1,000s, or you might just write off with MedPay. Now we're going for upper 5 digits, sometimes 100,000 plus, and sometimes more. So it's always a question worth asking. Sometimes it takes a few dollars off. Other times it's the insured trading a higher deductible for very little savings. So again, it can help from time to time, but several years ago, we used to be able to increase the deductible, or, well, can you add the coverage back for a little bit higher premium? And a lot of times that answer was yes. Anymore, it's not quite that easy, but definitely worth asking.
Got it. Thank you. So Jake, I'm going to come to you with this one. We got about 5 minutes left. So in 22 and 23, we seem to be getting a lot of quotes at the last minute due to the hard market and underwriters being very busy. Is that a trend you see continuing into 2024? I think in a lot of cases, the agents and the clients were getting things at the last minute, and it was frustrating for them to have things being released so late.
Yeah, it was frustrating for, I think, all parties, but obviously the last party presenting to the client has to be the most frustrating. From a renewal standpoint, we're actually seeing our renewals come in a little bit earlier than that 2 week to 1 week mark. Now I've seen a couple as far as a month out, getting back to that normal 30-day expectation. May take a little while this year, but I hope that that is the direction it's trending. And certainly we will be pushing for those renewal quotes as early as possible so that we can game plan and understand that this is not the same marketplace it was in 2023. You know, we may get favorable renewal terms, but that may not be the best terms in the marketplace, and we need enough time on the brokerage side to make sure you're presenting the best quote on the table. As for new business, it's probably gonna be about the same. You know, if we're getting a short fuse on a new purchase that they need coverage tomorrow, then you know we're gonna be in a tough spot and just work till it gets done. But renewals, I think they are trending in a better direction.
Kevin, same question for you. Do you see that a trend continuing in binding, or did you guys have that problem that brokerage had in the last couple of years?
I wouldn't say it's as much of a problem on binding as it is brokerage, just with you know, our binding authority being an in-house, having the PIN, as they call it, having the authority to make decisions in-house. I mean, it is still has been an issue with the market just having to remarket so many more accounts than we did in the past. You know, in the past when it was a soft market, it was almost like not an automatic renewal, but it was so much more of a seamless process than it is now. So with that being said, with you know, with rates improving, I am hopeful that you know that process is going to be a little easier, and that 30-day mark is going to be a very easy goal for us to hit to get those quotes out. You know, one thing that we have to monitor within our office with us holding the PIN and the authority to make decisions is our aggregate reports. We get those every 2 weeks, and it is a moving target. Sometimes we get that aggregate report in and we're tight in one zip code, and sometimes it opens up opportunities. So it's you know, I often have calls from my agents that what can we expect on this renewal coming in 3 months, or you know, potentially for a new business prospect, what can we expect if we're you know, we're trying to quote this business in the summertime. It's impossible to give an answer sometimes because it is such a moving target and a puzzle you're trying to put together with so many different factors like aggregates and construction types, so on and so forth.
Thank you. I'd like to squeeze another question too, but I think we'd run into a time frame issue. So first of all, thank you for the three of you for your expertise and giving us some good information as it relates to Habitational. I appreciate that. And more importantly, I appreciate all of our clients and our agents that are joining us today to learn more about Habitational and the marketplace and things that we're having. As I mentioned earlier, we're going to be sending out some information to you on this topic. We'll also have a recording of this seminar. And with that, you'll have some of the contact information you see on attached. And at the end of the day, there's some specific questions that people ask, and those are going to be items that we should take care of on an individual basis, whether you reach out to someone on this group or you reach out to your local Burns and Wilcox contact. Either way, the biggest thing, as everyone said, is make sure that you reach out early, reach out often, and let's communicate so we can take care of those issues well in advance. So at the end of the day, thank you for joining us, and we appreciate it.